Good morning. I am a retired 27-year veteran of Wall Street. I was a senior executive involved in trading currency, stocks, commodities, and derivatives and bonds. And I'm the author of Wall Street Journeyman. Today, many people feel fear and trepidation concerning their financial future. I understand these misgivings. Certainly, there's distrust towards Wall Street. After all, these rich financiers created this mess. The government bailed them out. Nobody went to jail, and the taxpayer paid the tab. There's suspicion towards Washington, D.C. We're running huge budget deficits, and our leaders are divided along partisan lines, unable to implement policy to put our fiscal house in order. Despite everything, we are now 4 years into a powerful bull market in stocks. Indeed, I am highly confident that stocks will remain strong for at least the next decade. I'm convinced that if people had a simple understanding of the history of modern Wall Street, they would feel more confident towards their own investing. Let's start with the 1920s. The Roaring Twenties seemed like a lot of fun. It was a decade of rampant speculation, price bubbles in real estate and stocks fueled by easy credit. Sound familiar? The banks were actively involved in stock trading and risk activities for their own account and with clients, including the aggressive allocation of risk margining and leverage. Ultimately, the bubble burst, culminating in Black Tuesday, October 29th, 1929, the great stock market crash. A financial panic ensued, ushering in the Great Depression. Now, besides the run on the banks, there are several key events in finance worth mentioning during this period between the 30s and the 50s. First of all, the Fed actually tightened or implemented restrictive policy, which refers to decreasing money supply and increasing interest rates. As an aside, the Federal Reserve is the central bank of the United States, created by an act of Congress in 1913. While there are many conspiracy theories concerning the Fed and the legality of its actions for monetary policy, the Fed is the law of the land. Now, on the surface, the Fed actions at this time make logical sense. We'd been through a period of speculative excess, and the Fed was trying to cool things down. There is significant academic work regarding the economic consequences of this restrictive Fed policy during this period, much of it critical. But what's key for our discussion is that these actions led to several decades of lackluster stock market valuations. The next event to mention is the Glass-Steagall Act, enacted by Congress in 1933, which separated investment banking from commercial banking. Stock trading and risk activities were moved to investment banks, and commercial banks were required to stick to standard banking, like holding deposits and making loans. The last event to mention is Bretton Woods. Late in 1944, the Allies met in Bretton Woods, New Hampshire, to establish a post-war monetary system. The dollar was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar. As an aside, gold peaked several years ago near $2,000 an ounce, but has fallen sharply and is currently trading under $1,300 an ounce. Bretton Woods worked pretty well for several decades before falling apart quickly in the late 1960s. During this period, Wall Street was a sleepy backwater. The best and the brightest were not gravitating to financial markets. 1960s, the U.S. government starts running large budget deficits, which leads to the development of a huge market for U.S. Treasuries, which becomes a big, profitable business for Wall Street. Bretton Woods unravels, the dollar is decoupled from gold, giving birth to a massive global foreign exchange market, another area for growth and expansion. Derivative markets like futures and options take off at this time. It's a period of growing employment and increasing profitability on Wall Street. Investment banks and commercial banks begin to skirt the regulations of Glass-Steagall and compete with each other. Congress does not pay attention. It was an era of high inflation and rising interest rates. As the 1980s start, Fed Chairman Paul Volcker takes decisive action to stem the tide of inflation. Paul Volcker is my hero. The long-term bull market in bonds begins. Budget deficits are increasing the supply of bonds, which are going up in price as interest rates move lower. This is a critical relationship to understand. Bond prices move inversely to changes in interest rates. As interest rates go higher, bond prices go lower. And the longer the maturity of a bond, the more sensitive its value is to changes in interest rates. During this period, hedge funds rapidly expand, increasing trading volumes and profits on Wall Street. The internet revolution in the 90s fueled a spectacular bull market in internet stocks, which swiftly reverses at the end of the decade. 1998, Congress repeals Glass-Steagall, but this is largely a ceremonial action by now. The 80s and 90s were really a golden era on Wall Street, where guys like myself could go get a fancy MBA, move into financial markets, and make big money. It was a modern-day gold rush. I mentioned it. At the end of the 90s, the U.S. government was running a surplus, which people forget. Economists were predicting huge surpluses for the next 20 years, and the politicians were fighting over how to spend this windfall. 15 years later, we're running trillion-dollar deficits, and our leaders claim nothing can be done. I hope we all know better. We move to the year 2000, and Fed Chairman Alan Greenspan eases, thereby increasing money supply and lowering interest rates in response to the internet stock collapse. Alan Greenspan, not my hero. Real estate markets boom and lending standards become reckless. Wall Street aggressively accelerates the growth in mortgage-backed securities, accumulating mortgages en masse, regardless of quality, packaging them into fixed income securities, and selling them at huge markups. Nothing new here. Wall Street creates lucrative products and sells as many as possible without regard for consequences. Investors lost a lot of money in mortgage-backed securities because they were seduced by high yields when the Fed was keeping interest rates low. Clearly, investors did not understand the risk of these securities, and the market for mortgage-backed securities collapses by the end of the decade. Now, when this bubble burst, current Fed Chairman Ben Bernanke accelerated the accommodative policies of his predecessor. 2009, stocks bottomed, they've been rising steadily since. Last year, bonds finally peaked and are now in a long-term bear market. What conclusions can we draw from this brief history of modern Wall Street? Economic conditions in the Roaring '20s shared many similarities with conditions in the past decade before the credit crisis. But the Fed's response to these crises represent complete opposites. In the 1930s, the Fed tightened, creating an environment where dollars were scarce and stocks were lackluster. This time, the Fed has aggressively eased, making stocks undervalued and dollars abundant. The Fed has enormously increased the supply of money after more than a decade of accommodative policy, but the velocity of money is low. This refers to how frequently dollars turn over in the economy. Banks and major corporations have been hoarding cash, but many economists believe the velocity of money is now starting to increase. Stocks represent great value regardless of your own employment situation or local economic conditions you observe. Major corporations have cleaned their balance sheets, streamlined operations, cut staffing and costs, and become more efficient. Let's discuss a brief plan to build wealth and create financial security. Unfortunately, today there is no interest available without risk, unacceptable risk. The Fed is keeping short-term interest rates near zero, as it can control them more effectively than long-term interest rates, which are at extraordinarily low levels and will inevitably rise, driving bond prices lower. Sell any bond you own and don't consider buying a bond for the next decade. The Fed and big-time bond managers are talking bonds up, to slow down the bond market decline. They know it's going lower. Avoid debt like the plague. Oh, what happened there? Damn it. All my good slides. Okay, avoid debt like the plague. In a deleveraging environment, you need to limit debt to necessities. What I was trying to say, and I lost my leprechaun. There we go, come on back, there we go. Do not buy gold. Leave it for leprechauns. Gold is a shiny metal used to make jewelry. Gold advertisements claim that gold has been money for 5,000 years, but it's not money today. If you want to buy food or pay your bills, you'll have to exchange your gold for dollars, generating transaction costs. Savvy institutional investors got long gold early in the last decade as a hedge. In the past several years, retail investors have been pushed into buying gold and are getting hurt. Gold is a negative carry asset due to storage and security costs. In my opinion, gold will continue to move lower to $1,000 an ounce and then consolidate for a long period. With credit conditions remaining difficult, property taxes rising everywhere, be very cautious towards real estate investment. Carefully consider cash flows. Your best option is to buy stocks. This thing is not working. Stocks represent a positive carry asset. Stocks pay dividends and have a high probability of continued appreciation during this period of unprecedented Fed easing. Put aside what money you can each day and buy stocks each month. Start with blue chip corporations that you know. Have some fun and do your own research. Ignore price swings generated by automated trading programs on Wall Street. Never invest in any product you don't understand. Avoid high-cost full-service brokerage firms. Open an account with a retail broker, with an online broker, reputable, and learn to buy stocks for yourself. It's not difficult. Pay no attention to talking heads or government officials. Listening to President Obama wail about the dangers of the sequestration was painful for me. Personally, I believe in budget cuts for bloated federal bureaucracies. The Fed is constantly in the news. We hear, which is overkill Congress never intended. We hear endless blather about qualitative easing, tapering, Operation Twist. What does that mean? Is Bernanke going to do his best rendition of Chubby Checker at his next press conference? Ignore all the nonsense. Sell bonds. Avoid debt. Do not buy gold. Be cautious with real estate. Buy stocks. Invest in a diversified portfolio of quality stocks and prosper for the long haul. Well, despite the negativity out there, I believe in America, and I'm very bullish our stock market. Thank you.